this video, we're going to look at Marathon Oil. And what we're going to do is calculate the intrinsic stock price of the company. So the way we're going to do that is we're going to enter the financial information of this company into our spreadsheet. And that way we'll be able to estimate the future free cash flows and then discount those cash flows back to today's dollars. And that will give us the intrinsic stock price, and we'll see if it's a buy or a sell. And then at the very end, we're going to look at the financial ratios of the company. So first we need the market cap, and we'll get all the info from Yahoo Finance, which is 5.8 billion, and a stock price of 732. And then we'll pull the free cash flows, and that's in the cash flow section on the bottom. And there's 1 year with a negative free cash flow. I added some notes to make it maybe easy to follow. So if a company has positive cash flow, then it's adding liquidity to its business. It's building its assets. So in 2016, it had negative cash flow. So that means it had to borrow money just to operate the business that year. And then the next 3 years, it had positive cash flow, which benefited the company. And it sounds like common sense, but if you have positive net income, that doesn't necessarily mean you added value to your company. And if you have negative net income, that doesn't mean you lost value to your company. Because you could have, it is possible to have positive cash flow and negative net income, and vice versa. Net income is a profit and loss, but it's accounting profit and loss. Let's pull the net income. Like I said, for net income, it could have, 2017, they lost $5.7 billion, but they had positive free cash flow. How could that be? Well, it could be a number of things, but most likely they borrowed money that year. When you borrow money, anytime cash comes in and out of your business, it affects free cash flow. So it was positive in 2017 to free cash flow when they borrowed money, but it doesn't really affect net income. It's just something to think about when you're analyzing a company, because I think people get tripped up with thinking, oh, net income is the most important thing. And if it's positive, that means they're doing good. And that's not always the case. Now, revenue is the easiest number to interpret. That's just the sales of the business for a calendar year. And it looks like they had a nice number in 2018, then a drop off in 2019. But it is difficult to model deals that have negative numbers. There's 3 negative numbers here. So I had to use a more conservative model. I have 4 models in this spreadsheet. So I had to use the most conservative one in order to get an actual value for the company. Otherwise, it would be negative, the stock price, which doesn't make sense. So we need a capital structure of this company because we need to know how to discount the cash flows. Because we already estimated the future cash flows. Now what do we discount them by? So the interest they pay on their debt is $280 million. Let's see how much debt they have. We'll go to the balance sheet for that. And the current debt, they have no current debt. It's all long-term. 5.5 billion of long-term debt. So they pay 5.1% interest on the debt, but interest payments are tax deductible. So let's find out their effective tax rate. And we'll go back to the income statement for that. So you see in 2019, they had income of $392 million, but they got a tax deduction of $88 million, which means they got a refund of $88 million. They didn't have to pay anything. So it uses accrual accounting, the income statement. So it's not as clean as free cash flow because it uses depreciation, a lot of non-cash items. So let's take the prior year to get a better sense of their effective tax rate. So in 2018, and for the model purposes, it's fine to use a different year. We just want the percentage of taxes they pay. So that looks right, 23% taxes. So the cost of debt is 3.9%, so it dropped because they got a tax write-off from the interest they paid. And you can see half the capital structure of this company is debt. That's not a great sign. It could be a lot worse, of course, but still 50% debt can really hurt a company, especially if interest rates rise. Right now, it's fine. So let's get the beta. The beta is 2.43. That's a really high beta. So beta is the volatility of stock. So a beta of 2 means the stock moves twice as the market. So if the market goes up 1%, this stock should go up 1%. And if the market goes down 1%, this stock should go down 2%. So this moves 2.5 times the market. So it is pretty volatile. And when it's volatile, it gets a higher cost of equity. It's 21% the cost of equity. So it's really expensive. When you compare that to the cost of debt, which is only 3.9%, that's cheap. Because equity is a lot more riskier than debt, because equity sits lower on a capital structure. So in the event of a default, debt holders are paid before equity holders. So to get the discount rate, you just combine the cost of equity and the cost of debt, and you get 12.67%. And that's a discount rate we're going to use to apply to the future cash flows. And when we apply that discount rate, we have the cash flows here that we estimated from the model. Then we discounted those numbers back to today's dollar amounts, and we get a value of the company of $5.4 billion. And when you divide that by 792 million shares, we get an intrinsic stock price of $6.85, which is pretty close to where it's trading at. It's trading at a 7% premium, so it's a sell according to the model. And you can see it was trading much higher before coronavirus, and then it dropped a lot. I'm sure oil prices have really affected this stock. And I also put some notes on how to understand stock prices, because a lot of people, I think, don't really understand how stock prices move. They think if a company is doing well, then the stock price goes up, and if a company is doing poorly, the stock price goes down. That may be the case, but stock prices, just to keep it simple, they just move on supply and demand. So when more people want to buy a stock, the price goes up. When more people want to sell a stock, the price goes down. Just like anything else in the market, it's based off of supply and demand. So a company can make tons of money and do really well financially, and the stock can go down because if people don't buy it, if people start selling their shares, it goes down. And a company could be making no money and the stock goes up because people think the stock is valuable. So just something to think about. But it's interesting to see how close it is to the model. But like I said, I have 4 models within this model. I had to use the most conservative model because the other 3 models came out with a negative stock price. So there's a lot of assumptions whenever you do this type of thing. Let's look at the financial ratios, because that's what a lot of people look at, because it's not that easy to build a discounted cash flow model that works and then running deals through it. It took me a lot of time to do it. So a lot of people look at ratios. That's more of a easier concept because you can just Google and find a ratio or simply calculate it. Let's calculate the ratios. I just need a few. So current assets, 2.1 billion. Current liabilities, 1.7 billion. Always make sure you're taking the right number. I know I messed up in the video too, especially in the beginning. So current assets, $2.1 billion. It's just assets that are expected to be sold, consumed, or used within 1 year in their normal business. And it's mainly cash, accounts receivable, that's what people owe you, and inventory, if you do have inventory. In this instance, it would be barrels of oil. So some businesses don't have any inventory at all. They're service type businesses. But those are current assets. Current liabilities is 1.7 billion, and this is the short-term obligations that are due within 1 year. So the most common are accounts payable and short-term debt. And they didn't have any short-term debt. And accounts payable are what you owe to other people. in Marathon's case, if they bought 10,000 barrels of oil, but they didn't pay for it up front, they paid for it on credit, then that gets billed to accounts payable. And then equity, they have 12 billion of equity. Equity is just your total assets minus your total liabilities. So it's the value of your company according to the balance sheet. I hope this doesn't seem too redundant, but I put what people call equity, because I remember when I started learning about financials, and I would hear so many different words, but they were all for the same thing. And then I got so confused on what they were talking about. Now I'm clear on most things. Of course, once in a while I'll have to Google a term if I'm watching Bloomberg or something and I hear a term I never heard of. I'll Google it. But so for equity, people call it shareholder equity. If you're looking at a private firm, the balance sheet of a private company, they may call it owner's equity. I usually call it book value. Some people call it net assets, but it all means the same exact thing. This is the value of the business. If they sold all the assets and used some of that money to pay off the debts and liabilities, would be the money left over, $12.1 billion. So if it's a negative number, that means the company doesn't even have enough money to pay off its debts, which I've seen several times. So proceed with caution if this is negative. So let's look at the ratios. And I picked 5 common ratios. So the price over earnings ratio is the price of the stock over the earnings per share. And generally, the lower the better. I like to see under 15. If I don't, I probably won't invest in that company unless the other ratios are really good. So if it's under 15, you probably have a good value. And if it's really, really high, it's probably a bad value. Or it could be a company that's growing and investing a lot into their operations. And that's why the PE is so high. But look out for things like stock buybacks and how they depreciate their assets and how they recognize revenue, because this could manipulate these numbers. Next is price over sales, and I like to see under 2.2, and it's really hitting all the marks so far, which is a good sign. And this is 1.2, and that's your stock price over your sales per share. And once again, stock buybacks and other things can really lower this number. So be on the lookout for things like that. Price over book. This is a really good price over book of 0.5. If it's under 1, that means it's really valuable, the company, according to its balance sheet. I look for under 3.3, but make sure to look at the balance sheet, even if it isn't under 1, because maybe the assets are really stale and not worth it. And even though the book value, the book value is just the equity. A lot of things could be going on, so you got to kind of connect all the dots. Current ratio is current assets over current liabilities, and that's just how you fund your day-to-day operations. So if it's under 1, that means the company does not have enough money in order to cover its operations for that year, and it will have to borrow and go into debt. This has a good current ratio of 1.22. I like 1.2 to 2. I don't want too high of a ratio, because then that means they're just sitting on a lot of cash. The ROE is not good. It's only 4%. I like to see above 20%. But it could be just a function of the industry. Some sectors just have low ROEs. So don't say it has to be over 20% or I'm not going to invest. It might have to be over 20% if you're investing in a technology company, but maybe if you're investing in an oil and gas company, it could be a lower number. And you should always compare ratios to similar companies. You can't compare the ratios to IBM, but you can definitely compare them to competitors. Unfortunately, I have 2 competitors that I'm going to compare them to, BKR and Occidental, who I did a video for recently. So I have the data in this spreadsheet that I could easily pull from. And we have the winner for each. So MRO, they're the winner of PE. They have a 12.1 PE, which is great. BKR is terrible, 133, and Occidental is negative, so it doesn't even give us a good value because they apparently lost money this most recent year, so it's negative. So you might have to look at other years to get a sense of it. They all have solid price to sales ratios, solid price to book ratios. So if you see trends like this, it just might be the industry is just how this industry is. And if you look at the balance sheet, you'll understand what I mean by that. They all have solid current ratios. They could all fund their operations this year. They all have really weak ROE, and it just seems like a function of the industry. The return on assets isn't as strong as in other industries. And in Occidental's case, they have negative because they lost money in 2019. And debt is something I look at, especially now, because I really think interest rates are going to rise. It's been like 10 years now, and they haven't. So I don't know. They have to rise sometime. We can't possibly continue on like this. Something's going to budge. So that's why I'm concerned with Occidental's 73% debt. If interest rates even go up from like 2% to 4% or whatever it is, that could double their interest payments and leave them in a really sticky situation. Marathon is 50%. I generally don't invest in companies that are over 50%. I mean, this is kind of bordering the line. But since they have such good ratios, I would consider investing in this company. But that's for you to decide. Every analyst has their own spin and viewpoint on this stuff. I'm just trying to convey the information to you and give you my opinion on it. So I hope you liked the video, and thanks for watching.